Hey guys, it's your boy, Ballface8020, back again with another great commentary. First of all, I want to wish everybody a belated happy Thanksgiving. Hopefully you had a good one. Mine was pretty good. I was it's all relative, right? But I had a good one. I would have liked maybe some more leftovers, but it was good. At least as far as Thanksgivings go. So tonight, or this morning, however you want to call it, the topic today is dollar death, economic collapse. We've discussed it before on this channel. And when beginning now, I want to start the talk with 2 points. The first is that whatever happens, whatever comes down the pike, one way or the other, I don't know. We can debate until the end of time or until it happens when the U.S. dollar is going to die, but it will, because it's a pure fiat currency, and fiat currencies eventually go to zero. Now, theoretically, it could be another 10 million years from now, but eventually it will. Eventually, all the people who are saying the dollar is going to go to zero, one day they will be proven right. We don't know when they'll be proven right. That's that's what we're kind of talking about. But eventually they will. The other thing is that when you're in this space, like the dollar skeptics or people who are into, metals, like when I mean precious metals, gold and silver, hard money, sound money, whatever you want to call it. There's a lot of people in this space who seem to be or openly rooting for, dollar death, economic collapse, and stuff like that. And there's multiple reasons for that. A lot of it is because some people just want to see the world burn. Some of it is because, these are people who are so alienated from our current political and economic climate that they want to see it. They want to see it fall to bring down the system that they hate. And certainly where I've been in the past. And the another reason is to just get it over with. They feel like it's going to happen eventually anyway, and it'll happen, and get on with it. And then with the idea being that, then it's possible to rebuild something new and better. And kind of like how Marxists, are always talking about late stage capitalism. Capitalism will eat itself, it'll destroy, there'll be pain, but then we can build true socialism on the ashes. And then another reason is that, a lot of people, in this space, they've put a lot of money their own money into gold and silver. And so, they've got, they would be better off, they may be thinking that they'll materially be better off in a time where, the dollar doesn't mean anything anymore. So all of a sudden their gold and silver, can actually be exchanged directly, or at least is worth a hell of a lot more. So, but for me, so if you if you're familiar with my stuff, I've talked about this before. I started talking about economic stuff in the COVID inflation. And I had a few things now when the COVID inflation first started, I was a skeptic, that it was going to be that bad or last that long. I think I have a video I definitely have a video. I don't know if sometimes YouTube just takes them down. A video called "Big Inflation is Not Coming." And I guess technically I was proven wrong on that, because the inflation did go longer than I expected, and it was worse than I expected. But I was also right that anybody who back then who was talking about permanent, 10% a year inflation was wrong. And I gave my reasons for why mathematically I didn't think that could happen. Sorry, choked on some spit. Yeah. Anyway, but I really thought, and I guess hoped, that there would be an economic or dollar crisis before the 24 election. one of my major concerns, possibly my most major concern about Trump getting back in office, was that there would be an economic crisis, the economic crisis on his watch. That it wouldn't be his fault, but he'd be the one who gets blamed for it. And, which, not only do I not want to see Trump get blamed for it, but it just like, that could potentially be a problem, if like the Democrats can make the public think that, oh, this was all because of Trump and not because of other shit, stuff like that. So, like I do have videos saying like, I think I've like the dollar is dead, it just doesn't know it yet. I've got a video titled that. And I thought, yeah, there would be, thought things would fall apart before the election. And I was wrong with that. And, I think the lesson that I take from that is to avoid trying to time these things. I can explain the fundamentals to you and explain to you, like, this is the trend we're on. This is where things will go if we don't change course. But, things can happen, and there's no way to put a time on it because, nobody really understands. Again, nobody in this space really understands how it's lasted as long as it has. Like, the U.S. dollar has been pure fiat since 1971 when Nixon, went off the gold standard. 55 years now at this point. I mean, almost 55 years at this point. I promise you, the people back then who are into sound money, like who were into, metals and currency, did not think that 55 years later, the same system would still be functioning. With problems now, that, have been building for decades and really came to a head post-COVID, but still functioning nonetheless. So, I stay away from timing this because I just don't know if it's possible, to time any of this shit. And if it is possible, it's possible for other people, not for me. I don't have the tools. So anyway, but why are we talking about it today if I've talked about it before? Well, because it's more topical now due to a few things, but the main thing is the boom in silver prices. Currently, I believe silver is over $57 an ounce, okay? A year ago, or maybe a year or 2 years ago, I don't know, it was about $30 an ounce. So it had like this big run up. I've talked about this in previous videos where these prices of metals that, whether they were artificially suppressed by banks and finance or just because pricing is weird, I don't know. But metals have been extremely undervalued against the dollar and other fiat currencies for a very long time. In the late 70s, they were getting really high, and then those prices collapsed in the 80s. With the 80s, there wasn't really deflation in the 80s, but there was disinflation. And you saw the prices of gold and silver collapse, not just in real terms, but in nominal terms. And they would have times where it would go up, but overall, if you bought a bunch of gold or silver in the late 70s, I mean, you didn't just lose money adjusted for inflation, you lost money in nominal terms over 20 or 30 years or whatever. And then I remember it looked like it was going to explode during the crisis in Europe in 2012, but then once Europe announced the bailout, it collapsed again. And I remember because but then my family's, like, the wealth that we did have was mostly tied up in gold and silver mines. And those things just went to shit. Now, on my grandfather, on his deathbed, made my mom promise not to sell the gold and silver mines. Because he said, like, yeah, I know they're, going to go down, but eventually they're going to go back up. And so, I mean, now, I'm the one who inherited them. And so now they're doing really well. Don't get me wrong. I'm still broke. I'm still en route to homelessness. But that is where most of my savings are in gold and silver mines. But the sorry, where was I going with this? Anyway, he so yeah, that's what happened, right? That whole thing with silver. But anyway, but now these last couple years things have changed. It started with gold exploded first, went from like 2,000 or something to over 4,000, and it's silver, which generally historically silver is 1/15 the price of gold. So gold exploded, but silver stayed put, and then silver now has recently followed up. And I think that on Friday or maybe it was Wednesday, I don't remember. Silver had a $6 a day. It moved $6 in a day, which for silver is pretty unprecedented, certainly within any type of recent history. So you might think like, well, who cares, right? Like, so the prices of gold and silver go up. Well, because like when you understand how money works, initially a dollar, was based on, nobody gave really a shit about the paper dollar or whatever. It's because you could exchange it for physical gold and silver. Now, granted, you haven't been able to do that since 1971. Even before 1971, you couldn't really do it, since like 1913. But like you could do it on a country level. Like France could say something like, hey, here's $8 billion in cash. How about you give us our gold, our $8 billion worth of gold. And but you could at least, like, there was at least some type of, exchange for it then. But since 1971, it's been pure fiat, like a dollar's worth a dollar because the government says it is. And, if you get to a situation, right, like, but so ultimately that's where it comes from. It's the root of like why the dollar exists, why people care about it at all, is because it initially could be exchanged for gold and silver. And you can look at the history of all paper money. It's always been like that, even if it's not government issued. They were called banknotes. That's where dollars and paper currency come from. Was your banknote could be exchanged for physical gold or silver that was at the bank. Now, so what this means, right, is if if gold and silver keep going up, you theoretically, first of all, it's just a sign of strain and a sign of lack of faith in the currency. But it could get to a point where, like okay, the dollar, like silver is what, like $57 right now. All right. Well, what happens if you have a time where silver is doubling every year over time? It's not going to take long before people realize my money is not holding its value, compared to gold and silver. I want physical silver. And then they're going to be buying into that. And then you get to a point where people stop like even wanting to take money for services. Be like, why would I take $100 to sell you this bicycle tire or whatever, if that $100 is going to be in silver terms is going to be worth like $50 in a year? It's like, no, how about you just give me the silver? And like people like, and people will get to a point where they're now look, by itself you can maybe deal with it as long as other prices remain the same. But it becomes a kind of a negative feedback loop where people get, again, it's pure fiat money. The whole thing is based on confidence. And if people start losing confidence in this currency, then even without like policy problems or, like with debt or spending or, just the sort of problems that we have with our current financial system in general, you can let to a twist because it's not inherently worth anything. People could theoretically just stop accepting it, and or at least trending towards that, and that creates more inflation and more problems. So why don't we start by talking about what causes inflation? Because It's like a lot of people don't understand it, including most of the people who are in charge. And like when you see people talk about how, oh, tariffs are going to cause inflation, it shows, a real lack of understanding of where inflation comes from. And before the tariffs, when you had Biden in office, you had people saying, oh, the inflation is because of COVID, or because Biden wasn't drilling enough or shit like that. And, again, it shows like a real misunderstanding of what inflation is. So the first thing we need to establish is that in a sound money system, that's when money is based on, it's either gold, silver, or it's paper that can be exchanged on par for a set amount of gold and silver. Like when that's the only money you have. In that system, there is no inflation, okay? There is no, we have got you've got thousands of years of history to prove it. Now, you might have prices of certain things go up, like if there's a famine, the price of food's going to go up because, there's like to deal with the scarcity. But the overall like prices, when you combine everything together, is going to be about the same. Like it might go up a little some years, might go down some years, but basically it's about the same. So when we get to the, so fiat currency, as I've been talking, like the current, really every currency in the world, just means a currency with no intrinsic worth. So it means like, you can have, there's a couple kinds of money you can have. You can have actual gold and silver, or you can have paper money or whatever that can be exchanged on par for gold and silver. And then you can have sort of like a semi-fiat money, like during the United States Civil War, there was the currency was called the greenback, which the government just printed. But the idea was even then that, okay, for the duration of the war, we're just printing it. But when the war is over, it's going to be reevaluated, and you will be able to exchange it for gold or silver then. So that's like, you could call that semi-fiat money too. But then there's also pure fiat, where you cannot exchange it for anything. A dollar is worth a dollar. It has uses, but it can't be exchanged for, like, it can't be just exchanged for, you can take it and go buy gold and silver, but you can't exchange it for a fixed amount of gold and silver. And, like to the bank that's issuing it, to the U.S. Federal Reserve or to your bank or whatever. Now, so one issue with fiat currency, and there are several, but one issue with fiat currency is, like I've been saying here, it has no intrinsic value, which means that, like, okay, because like silver and gold have intrinsic value, if you had a time where, like, okay, like you've got there's an economy that's just everybody's trading with silver or something, okay? If overnight the supply of silver was to increase by like 10, then yeah, you'd see prices go up in terms of silver. Similarly, if somehow like everybody woke up and then just like 90% of their silver had just suddenly vanished, prices would go down. With a fee, because the silver has intrinsic value, so it's always going to be, what you can get for it depends on what's available, but it's got that intrinsic value. With a dollar, it's not necessarily going to be like that, because because there's no intrinsic value, people can always just stop accepting it. People can't stop accepting gold and silver. An individual could, but those things have in value. Whereas the dollar, take one guy who's got $1,000 in dollars, another guy's got $1,000 in gold. Now imagine the United States government just collapses one day, So that guy with the $1,000 now has $0 because it doesn't mean anything. And the guy with the gold, though, still has his same purchasing power, probably more. Now, so what would happen? The reason I'm even reiterating all this, because I know I've said this in like 5 different times so far, is because it means that this is one way inflation can happen. That even if everything is fine, in a fiat system, even if everything is fine on the back end or whatever, since there is no inherent value, the currency can lose value just by people losing faith in it, even if mathematically there's nothing wrong. You want to see a good example of this is like Venezuela right now. You know, they're, which is, I mean, it's not their only problem. They've got many. But like currently inflation in Venezuela with their own currency is about like 500% a year, which is way better than it used to be. It's that 500% a year, it's bad, but it's not hyperinflation. But they've got a balanced budget. So their spending is, I mean, they've got other problems, but in terms of spending, that's not really what's causing their inflation. The problem is that nobody trusts that fiat currency because nobody trusts the Venezuelan government. So since the government there has no credibility, people are like, yeah, okay, they're not printing now, but who knows when they're going to. And it becomes like a self-fulfilling prophecy because people don't trust it. It loses its value, which means people trust it less. So they spend it even faster because they know it's going to lose its value, which makes it go even less, which makes people spend it faster. You know what am I making sense? So that's like the first problem is simply by people losing faith in it, it can lose lots of its value and have inflation that way and potentially lose all of its value. So that's the first way it could happen. The other way it can happen, inflation can happen, is let's say people got total faith in it, like most people today have in the US dollar. The ratio of money to money and credit to the overall amount, the size of the economy. We say the size of the economy, but when we say that, we mean the goods and services available in the larger economy. So that ratio gets worse, as in the money supply expands faster than the amounts of goods and services. And so the example I would give for this, because I want to illustrate it for you guys, is let's say that the money supply stays constant, okay? Because what you think, right, is just like, okay, well, and I've said this before too. I said inflation's basically just the increase of the money and credit supply. And there's people who say that, and there's something to it. We'll get to that. But but it doesn't really have to be that way. It's not necessarily true, at least theoretically. So let's say everything stayed the same. Money supply and credit stayed exactly the same. But suddenly, tomorrow, there were only 500 loaves of bread in the entire country. Even though there's the same amount of money available, the prices of each of those loaves of bread are going to go to the moon. Because the same amount of money is chasing fewer goods and services. Now, similarly, let's say that tomorrow we woke up and there was 10, a million times the current supply of bread. You had bread going everywhere and stuff. The amount of money in the economy is the same, but bread is going to be basically free because, people are just going to be trying to, give it away and stuff. And even though the overall money supply stayed the same, and you can do the same experiment with pretty much anything in the economy, like suddenly land doubles for some reason, or there's now twice as much housing, there's now twice as much energy available, there's now twice as much food, clothing, whatever. Or the reverse thing, there's half as much of that. You're going to see prices going even with no change to the money supply. So that's one way things can happen. But the thing is, in practice, we don't generally see those dramatic swings in real wealth in the economy in modern industrialized societies. Now, like in the Middle Ages, like during a famine or something, or a war, that would be a different story. Like, there just simply wouldn't be as much food. So, you could have that would be like there's less, wealth or whatever. I mean, there's less wealth for that same amount of money to chase. But in industrial, and theoretically, it could be it could change. But for our experiences now, in industrialized countries, the real wealth mostly doesn't change. I mean, it's not that it doesn't change. It generally it grows. It gets bigger. The total amount of wealth, but not like so dramatically that you need to look at it as a major driver on inflation. So when people say stuff like, "Oh, like the tariffs are making inflation worse," I mean, they could mean a couple things by it, but one thing what they're saying is that, well, you're not getting as much, not getting as many goods into the U.S. So the supply situation has been restricted. So that means you've got, again, fewer, the same amount of money chasing fewer goods. But that's what they're talking about. It's something like that. In practice, the tariffs don't reduce imports enough for that to have a meaningful impact. But theoretically, they could be right. But anyway, so like I said, so in practice, though, yes, rising prices for our purposes are primarily, at least in the United States, it's different in other countries because their currencies have to also, and we'll talk about this later, their currencies have to worry about their value against the dollar. But let's just focus on the United States, which it doesn't matter what the dollar can't be against the dollar, so it doesn't matter. But for the United States, primarily, like when we're talking about rising prices, more than anything else, this isn't the only factor, but far and away the most important factor of rising prices in the United States is going to be the rising supply of money and credit, in relation to, well, I mean, it's kind of redundant for me to say this, but in relation to the size of the overall economy. And then just a quick aside. So part of the reason the COVID inflation was so bad is because you had a rising supply of money with a contracting size of the economy. And in nominal terms, I mean. So you're seeing fewer goods and services on one hand and more money. So that made the inflation worse than it would have been if it was just the money supply had increased, but the economy had too. So that means, again, so basically what I'm saying, this is a long-winded way of saying it, is for our purposes here, inflation in the United States, really the only thing we need to look at is rising supply of money and credit. So, okay, everybody knows what credit is, but what is money? We think we know what money is, but, when you start breaking it down, it becomes less clear. I think that, this is where I started and where I think most people would start is like when you ask what is money, you'd say physical currency. $100 bills, $20 bills, coins, physical cash and coins. Well, that certainly is money. The problem with that is that it's not sufficient, right? It's not a sufficient definition because what about checking accounts, savings accounts, money market accounts? Because those function exactly like physical cash. Like, you likely, if you're watching this video, don't get paid in physical cash. You get paid by, things going to your bank account. And, I promise you, the bank does not have the cash of that amount in their vaults, reserved for your account. That's not how banking in our country works. In the whole world really works. Maybe in some Islamic countries, I don't know. But excuse me. But Right. So really, you get to a point if you want to measure the money, if you want to include like checking accounts, like any type of thing that you can use to pay for stuff on demand, like, so like a debit card or a checking account, money market account, some savings account, some smaller CDs, money that like is known, you have access to this, like I said, on demand. You can use it to like pay for something. You can theoretically sell a house or sell stocks or whatever, and then take that money and buy something. But you can't pay for something with stocks or a house because it's not liquid enough. People, when they're charging you, like the people when you go and buy a soda at the store, they don't want like a percentage of some stock that they have to go sell to get their money. They want the money. And, it doesn't have to be cash, but it has to be like a check or a card or something that's just as good as cash. So when you just look at the amount of cash in the economy, that's in practice, there is more money than that because people treat stuff like that. So if you're going to use physical cash plus these kind of on-demand at par accounts, then you get to like what is the true money supply. Now, the federal government doesn't really, or the Fed actually, doesn't really measure the true money supply, but they do have money aggregates. There's the physical cash is M0. Then there's something else as M1, but I've never figured out exactly what it is. But M2 is the closest thing we could think of to like true money supply. Now there are these two, they're called Austrian economics because they come from the tradition of F.A. Hayek and Ludwig von Mises. Salerno is one of the guy's last name, Murray Rothbard is the other guy, who invented this metric called the true money supply, which you can go look it up if you would. I like the true money supply better, but it's harder to find because the M2 gets published by the Fed. The Fed doesn't publish the true money supply because most of them probably don't even know what it is, and they certainly wouldn't care if they did. But the true money supply tends to be usually about like 50%, 25 to 50% higher than the government's M2. But use whichever one you want. I mean, they're both good. They're both good metrics for the amount of actual money in the system. So that's your money, and money. So where does money come from? Well, we know in our system, because it's not gold and silver, it's fiat money, which means what? It means it's created by the government. Okay, but what's the mechanism? How does the government create money? And sorry if this is boring, but this background is necessary to like explain where I'm going here. Well, it took me a long time to figure out how the government created money. And there was even a thing from like 2 or 3 years ago where like one of Biden's advisors was like in an interview. You can look it up. He was asked how money was created. And he was like going in circles, and he was just like, I don't know. like I don't get how it happens. But here, the way it works is the Federal Reserve has this thing called open markets operation. And what it does is, so if for the government to create money, what they do is they buy securities, which are loans, bonds, whatever you want to call them, on the open market. And let me just give you like an example of how this would work. Usually, now the Fed can buy whatever they want, pretty much, but usually this is government debt. So here's what happens, right? A bank, a large commercial bank usually, maybe always, I'm not sure what exactly how the Fed's rules are, but let's just say a large commercial bank, they've got their deposits, they've got, the people have put in with them or something. So they've got $10 million worth of money. Now, it may not be all physical currency. Theoretically, none of it could be physical currency, but when we call them M2, true money supply, but they have $10 million of money, of what our system is called money. So they've got $10 million or whatever, or they take $10 million. They have however much, but they take $10 million. And the government, who's always in debt, is like, well, we need $10 million, so they have an auction saying like, what's the lowest interest rate, somebody will take for, a $10 million loan. So then this company, the bank says, it's like goes and bids on the auction and is like, okay, we will give you this 10 million bucks that we have, it's because it's deposited in us, but we're treating it as ours because technically it is theirs. And we're going to buy, we'll give you the $10 million. Here's our $10 million. You give us the bond note, and with the idea that you're going to pay 2% interest a year, until at the end of 10 years you pay it all back or whatever. And I'm not sure if it works more like a mortgage where you pay it down, or if you pay it all I think you pay it all at the end, but I'm not sure. And then except for the interest, which you pay during the thing, I think. So the government's like, great. So the government now has $10 million that they can use to fund their operations, whatever they may be. The bank has got this piece of paper, and then maybe some interest coming in. So, but they no longer have those $10 million in their vaults or account books or whatever. They don't have that. They just have the note. So this is where the Fed comes in. So then the Fed, if they want to create more money, says, okay, that note that you bought from the federal government, sell it to us. We will pay you for it. We'll pay you $10 million, maybe more than $10 million for that same note. And then probably more, right? But we'll pay you plus for whatever the interest is. So you will get a percentage. I mean, you've made a profit, however much, whatever the difference is between, the interest and whatever, but we'll buy it for you. And now you've got $10 million again. So so great. So the Federal Reserve went and bought that $10 million. So it would seem like it's just kind of like, well, who cares, right? Everything's just getting pushed around. Like, he had $10 million, goes to the government, and then the government buys it back. So nothing really changed, right? No, because the Fed and the government are technically separate. The Federal Reserve can't tax. The Federal Reserve doesn't have any money. So the Federal Reserve, how does it get the $10 million to pay for the bond that it bought from the bank? It prints it. And sometimes it'll physically print it. Sometimes it'll just like put it on numbers on the balance sheet. It's all M2 or M true money supply. In practice, it's all the same thing. So poof, you've just created $10 million. And that's how money gets created. I mean, it's pretty fucking stupid when you think about it. But no wonder so many people don't understand how it works. But in practice, though, like, say you might think, well, what's the difference in practice between doing it this way and then just having the government cut out the middleman altogether and just be like, oh shit, we need $10 million, let's print it. Well, the difference is that there is none. That it's literally the same thing. And it's crazy when you think about it, but that's how the system works. So hopefully now it's starting to make sense to you, like why everything's so fucked up. So I think the question people would ask is, okay, so that's how the new money gets created. Well, when inflation gets bad, why not just stop doing the open market operations? And in fairness, that's probably what they were thinking when they started the system in the first place. The problem is you kind of can't stop the open market operations when you're in a fractional reserve system. And, fractional reserve is that you deposit money in the bank. You deposit like $100 in the bank or whatever. The bank keeps theoretically $10 in reserve. In practice, they don't. They usually keep like less than $1 in reserve. But supposedly they're going to, for the point of example, for example purposes, they keep $10 in reserve. $90 they loan out. Okay, no problem, whatever. The problem though is that, in your checking account, you think, how much do I have in the bank? I've got $100 in the bank. Well, no, actually you don't. There's only $10 there because the other $90 have been loaned out. And then that person thinks the same thing. That person thinks, I've got $90. Well, okay, yeah, you do have $90, but in a sense you don't, because the first person also is making claim to those same $90. So you end up in a situation where, and this is how it started, like back in the day when they still used gold and silver and stuff, because that's how it would be. Like you put gold in the bank, okay? You'd put your $100 worth of gold in the bank. The bank would give you banknotes saying you can redeem these notes for these 3 ounces of gold that you deposited, whatever. Then the bank realizes, wait a minute, this gold is just sitting here doing nothing. And the person's probably not going to come back and like demand it all out at once. So since people accept these notes that we hand out just the same as money, why don't we just hand out, more notes to people and charge them interest on that? Which is great, except the problem is that you end up in a situation kind of like if you ever see the movie The Producers, where they keep selling 10% of the play to like 1 million different people. So you've got a bunch of people with the claim on the same thing. So it becomes worthless. It gets to a point where so you have you end up in a situation where you've got multiple people with a claim on this same fixed amount of gold, money, whatever. And that creates bank runs and the system goes bust. And a lot of people lose a shit ton of money. So the reason this is relevant is that since there's not enough money, certainly not enough physical currency, but even not enough, just overall money supply to service the amount of debt that's in the economy as is. Like it physically doesn't exist. The Fed, once they stop their open market operations, every time they try to stop the open market operations, the system grinds to a halt and implodes. And you get not really bank runs because we don't have them anymore with the FDIC, but you get like what happened with Silicon Valley Bank, a couple of years ago. And, it starts to grind to a halt because what happens is the banks, they need some amount of currency or whatever. They need some amount of money, currency, money, whatever you want to call it. And, just to honor their deposits. Okay. So for people who come to pull it out, that they have it there. And then, so what happens then is when they need that currency for themselves to honor their deposits, they're no longer able to loan that money out because they need it in case people come back, that they have enough when people come back to give them money, to give them their money. Again, this is what happened with Silicon Valley Bank. And because our system, has gotten to a point where it's so dependent on speculation and new loans, this dries up the entire economy, because the system is so fucked up that basically it needs the sugar high that you get from loans to keep functioning. If the loans don't keep happening, if we don't keep making new loans, the whole system falls apart. And so that's the thing is in our system, the way it works, no credit expansion means freezing and contraction, and maybe even collapse. And you saw this in 1929, 1937, and in 2008. And then also it becomes an issue of like the U.S. government deficits are so bad, like they're like I don't even know how much percent, like 7%, almost 7% of GDP. If the Fed doesn't continue to pump new money into the system, like I said, then it's like loans. There's no new loans in the private sector, which is bad enough. But even loaning to the government becomes problematic, because everybody's going to be like, well, like, if you want me to loan you, if you want me to loan you, $10 million or $10 billion or whatever to the government, it's like, yeah, okay, fine, but I'm not going to do it for 2% interest, okay? That because there's more risk now, you're going to have to, and like, because like there's so many we need the currency in our banks, for deposits. There's so much less currency now to go around to even loan to the government. So now the government, for those $10 million deficits, they're not going to be paying 2% interest. They're going to be paying 18% interest, which the U.S. government can't afford. So basically, yeah, like I said, it's like being a junkie, and you need more and more to just stay where you are, to just run in place. It's a really fucked up system. So that's why they don't do it, because they as recently as 2023, the government tried to do, they said, instead of, not only did the Fed stop buying new bonds, okay, but they started selling their bonds. They said, okay, they call it reducing their balance sheet. So we're going to take all these loans that we have on our books, we're going to sell them back to the banks, take the money and retire it from circulation. So we're actually shrinking the money supply. Yes, this is true. The government was doing this in 2022 and 2023. Now, while they were doing this, prices weren't going down, but that's because, first of all, you have to look at prices are a function of not just the money, but also the total amount of credit, which was continuing to expand. But also, it would have taken a while for it to kick in anyway. It would have taken 12 to 18 months. But they were doing it. They were shrinking and shrinking it. I mean, buying and buying, retiring currency, and then you had Silicon Valley Bank collapse. And at that point, the government basically stopped shrinking the balance sheet. They basically kept it the same, and then since then have been expanding it pretty rapidly. Because if they had continued on the path that they were on, it wasn't going to stop with Silicon Valley. Eventually, it was going to be every major bank in the country, and which would mean that the federal government would have to come in and backstop all of them, which is kind of what already had happened in Japan. So, like I said, there's no way out. I mean, we would. Now, the thing is, these are solvable issues. These could be fixed. However, how you would fix them is A, beyond the scope of this video, so I don't want to talk about it here, and B, as far as I can tell, there's no politically feasible way to fix it at this time. Someday it'll get worked out, but, the public isn't ready for it. But most importantly, the American leadership class doesn't even understand the problem. So there's no real, you need to fix it. You would need, I know the politics are really bad and divided, and, it would be difficult. But it's not just that the government or leadership class is unwilling to be honest with the public and make hard decisions. They're not, and that's bad enough on its own. But it's that they don't even understand the problem. So if you don't even understand the problem, how could you solve it? So that's, why we are there. But I don't want to talk about potential solutions in this video. It's already gone on a really long time. So anyway, so I just gave you all the bad of that's the thing. So people who are talking about the dollar being dead or the dollar being doomed, they would basically just say, for all the reasons I just talked about right now. But it's not the whole story. The dollar is unique against other fiat currencies and really any fiat currency ever. And it's unique because there is tens of trillions of dollars worth of dollar-denominated debt out there. So on one hand, you can say a dollar doesn't have any intrinsic value, which is true. But in practice, there are, like I said, tens, maybe hundreds of trillions of dollars of debt out there that can only be paid in dollars. So, and again, and the dollar functions as you well know, the global reserve currency. So it's got some value from that too. So the dollar, just becoming completely useless, even if nobody had faith in it, it would still have value because you need it to pay back your dollar-denominated debts. And there's a shit ton more of dollar-denominated debt than there are actual dollars. So that is going to keep the dollar's value artificially high. And when you talk about other currencies, they're all tied to the dollar. This goes back to the whole global reserve currency. When North Korea wants to import something, how do you think they do that? They can't pay for it in their North Korean currency because nobody will take it. Well, what are you going to do with a bunch of North Korean currency? So what North Korea does is they either barter, they'll be like, we'll give you some food for some manufactured goods or whatever, or they barter something for US dollars, and then they use the dollars to buy what they want. And whatever problems the dollars has, the other currencies have it even worse. And that's one thing. So that's one thing that I'm optimistic, politically optimistic about, is that I'm pretty confident that when the dollar finally dies, it's going to be the last man standing before that. So the dollar will not die before the yen or the euro or even some currencies that look good like the Swiss franc. Those currencies will all go first, which means that if the dollar does die on Donald Trump's watch, I don't think it will, but if it does, it'll be because every other currency fell too. And they'll try to blame it on Trump because they always do, but nobody will buy it. The other thing about this, the dollar's dying, we're all doomed, whatever. Well, look, I looked at bond yields. Bond yields are down. They're I don't know, they're a lot lower than they were 2 years ago. They're not great, but generally you would see if you saw a real loss of faith in the currency, you would see bond yields go up. The government have to pay more, to fund its debt. But instead you're seeing sort of a flight to safety. So this, happens this boom in gold and boom in silver, and it's happening at the same time that bond yields are going down, not up. It looks less like an inflationary event than people reacting to uncertainty. So because there's so much uncertainty in the world, people are going to the dollar, which they get to invest in. Buying bonds is investing in the dollar, and then, or buying in gold and silver. Personally, I think you're a lot better off with gold and silver. There are a lot of problems with the dollar, but it seems to me like more an issue of uncertainty than loss of faith in the dollar per se. That's what it seems like to me. Things could change, but that's my read on it now. Another thing is that assuming we're not going to have a loss of faith in the dollar, and I don't think we are, and assuming that we're not going to see a dramatic shrinking of the amount of goods and services available in the economy, which, as I discussed earlier, there's no reason to expect anything like that either. Well, in that case, the only way you could have major inflation is a big expansion of the money and credit supply. So a lot of these silver and gold people say to bail out the banks, the Fed is going to need to print large amounts of money to keep those banks solvent so that depositors can get their money. No, not really, because that money essentially already exists. So yes, technically speaking, the Fed could have to print more cash to back up what's in those deposits. But in practice, the money in those bank accounts already gets used as cash anyway. So you're not changing anything. That's why all the money printing during 2008 and during the early amount of COVID, yes, I know we had bad inflation after COVID, but it was nothing compared to the amount of money that was actually printed. No, prices are more a function of the amount of credit in the economy, and the amount of credit dwarfs the amount of money, as I said earlier. Like, it's about four times that, maybe more than that, I think. In fact, definitely more than that. It's more like 8 times, I think. And that's just in U.S. There's also overseas debt that's in U.S. dollars too. So the amount of credit, at least domestically in the U.S., is expanding at about 5% a year. Pre-COVID, it was like 4.5% a year. So we wouldn't necessarily expect, like, yeah, look, it can go up and down, but pre-COVID, you had inflation, it was, around 2% a year. Now it seems like we're about 3% a year. So maybe, if you're lucky, you get it down to 2.5%. But even if it stays at 3%, which is certainly possible and certainly could be politically really bad for Trump and the Republicans, that's not really major inflation. So in the short term, I don't really see a collapse or even something like 10% inflation. I don't even see 5% inflation, because where is the money to get you 5% inflation supposed to come from if credit's only expanding at 5% a year? That would mean that you'd either need to A, have a huge decrease in the amount of goods and services, which I'm not expecting, I don't think anybody is, or B, you would have to have just a mass loss of faith in the US dollar. Well, there's no sign of that. Some of these other currencies it might happen to, but not to the dollar. So I still believe in gold and silver in the long run. One of the best investments I've ever made, probably the only good investment I've ever made. I still have no faith in the dollar in the long run. I have less than no faith in all the other fiat currencies. But when people are talking about like a near-term dollar collapse, it could happen, but I'm not seeing it from the data that's available right now. That's all for now. See you in the next.